What if everything you believed about the 2008 financial crisis is upside down? What if the meltdown wasn't just the result of bad mortgages, but a deep structural defect in the system? One that almost no one saw coming, and that still hides in plain sight today. In this video, we're going to peel back the layers, reveal the hidden forces, follow the dominoes all the way from an obscure mortgage in subprime America to Lehman's collapse to a global contagion, and show you how the same patterns are quietly replaying today. Let's begin. By the mid-2000s, it seemed like the US and global economy was cruising on autopilot. Even after the dot-com crash and 9/11, central banks had pumped liquidity, restored confidence, and raised valuations back to new highs. Many analysts spoke of a great moderation, a belief that volatility had been tamed, that financial crises were relics of the past. Banks had transformed. The old model, banks as originators and holders of loans, had given way to a new architecture of originate and distribute. Mortgage originators would sell off loans, investment banks would slice and dice them, package them into bonds, and investors all around the world would buy them. Risk no longer resided locally. It was hidden, distributed, sliced, and leveraged. At the helm of this system were some towering personalities. Ben Bernanke, chair of the Federal Reserve, who pushed low rates after the early 2000s recession and believed in managing financial cycles. Henry Paulson, U.S. Treasury Secretary in 2006 to 2009, a former Goldman Sachs executive who would later lead the bailout efforts. Timothy Geithner, president of the New York Fed and later Treasury Secretary, who understood the shadow banking system and would be central in crisis management. Executives at Bear Stearns, Lehman, AIG, Goldman, Citigroup, and others who bet heavily on complex securities, derivatives, and leverage. At the same time, U.S. housing markets had become the backstage stage for a gargantuan bubble. Home prices rose year after year, fueled by cheap credit, financial innovation, and a collective belief that real estate always goes up. But beneath the gleaming facades lay cracks. Weakening underwriting standards, skyrocketing household debt, over-reliance on short-term funding, regulatory gaps, and a global flood of capital-chasing yield. This is where our story really begins. To understand 2008, you must go back earlier, to the early 2000s. After the 2001 recession, and shaken by 9/11, the Federal Reserve gradually lowered the federal funds rate from about 6.5% in 2000 to near 1% by 2003. Why? To stimulate growth, restore confidence, and fend off deflation. But the side effect was dramatic. Capital became cheap, credit became easy, and risk-seeking behavior exploded. Global capital flows joined the party. Countries like China and oil exporters accumulated huge surpluses and invested them in safe U.S. assets. Over 60% of the increase in U.S. mortgage funding came from overseas. The result? Yield hunting across the system. Investors chased anything that promised steady cash flows, especially mortgage-backed securities, MBS, collateralized debt obligations, CDOs, and exotic derivatives. The emergence of subprime and the death of rigor banks and mortgage originators loosened lending standards, in part driven by competition, in part driven by beliefs that housing always appreciated. Subprime mortgages, loans to borrowers with weak credit, expanded rapidly. In 2001, subprime made up just 7.6% of mortgage originations in the U.S. By 2006, that figure was 23.5%. The rise in risky lending came via high loan-to-value ratios, enabling borrowers to buy with minimal down payments, adjustable rate mortgages, ARMs, low teaser rates resetting into much higher payments, interest-only loans, negative amortization, no-doc or liar loans with minimal verification. But originators couldn't keep that risk on balance sheets. They sold the loans. That's where Wall Street entered the game, bundling mortgages into securities, slicing them into tranches, selling ratings, and repackaging them further, creating layers upon layers of risk hidden inside complex structures. Unchecked leverage permeated every corner. Investment banks borrowed heavily to finance their bets on these securities. Shadow banking, non-bank financial institutions, hedge funds, repo markets grew gigantic, but without the safety nets. Banks had no deposit insurance, no central oversight. Credit rating agencies were supposed to be gatekeepers, assigning risk labels to securities. But in practice, they were deeply conflicted. Paid by the issuers themselves, they often gave OAA ratings even to tranches backed by dodgy mortgages. Even worse, so-called synthetic CDOs allowed bets on subprime defaults without underlying mortgages. In effect, Wall Street was betting on both the growth and the collapse of the housing market simultaneously. By 2006, house prices peaked in many U.S. metro areas, debt-to-income ratios soared, and mortgage lending had become a giant leveraged pyramid built on assumptions. The illusion of diversification, Wall Street sold the lie that slicing risk across thousands of mortgages made it safe, even earthware. Global investors, from pension funds to sovereign wealth funds, poured money into these structured products. Risk became distributed, or more accurately, hidden. Because of this, financial institutions believed each piece was safe by itself. The notion was one region might default, but elsewhere mortgages would perform. So they amassed huge positions in related derivatives, leveraging them heavily. In parallel, the repo market, where institutions borrowed cash overnight against securities, grew huge. The problem? Repos are short-term, highly dependent on market confidence. If counterparty trust collapsed, funding evaporated. Banks, investment firms, and shadow institutions borrowed short to bet long, creating a fragile structure propped up by confidence and liquidity. First, cracks appear in 2006, 2007. Home prices started to stagnate and then fall in some states: Florida, Arizona, Nevada. Borrowers with adjustable mortgages began to default as their payments reset upward. Defaults rose in subprime and Alt-AA segments, especially in weaker markets. Brookings +3 FDIC +3 King Center on Global Development +3 mortgage-backed securities began to show losses. Investors looked more closely at the tranches once believed safe. Liquidity started drying up for lower-rated tranches. A pivotal moment. Bear Stearns in early 2008. Its two hedge funds lost massive bets tied to subprime derivatives. Counterparties hesitated to roll over financing. In March 2008, Bear was acquired by JP Morgan in a fire sale deal backed by the Fed. That signaled to markets the fragility of highly leveraged, interconnected firms. In parallel, Northern Rock in the UK experienced a bank run, depositors queuing as its reliance on wholesale funding collapsed. This was a warning that the modern banking paradigm had limits. By late 2007 and 2008, credit spreads widened, interbank lending chilled, and liquidity risk became as feared as default risk. The tipping events? September 2008 is when the story accelerates into collapse. September 7th, the U.S. government takes over Fannie Mae and Freddie Mac, entities that guaranteed a large portion of U.S. mortgages. Their insolvency risk threatened the entire mortgage finance system. September 15th, Lehman Brothers files for bankruptcy, $619 billion of liabilities, the largest in U.S. history. September 16th, the government commits $85 billion to bail out AIG, an insurance giant whose credit default swap exposure threatened massive counterparty losses. Late September, Washington Mutual is seized. JP Morgan acquires its assets. October 3rd, Congress passes the Emergency Economic Stabilization Act, creating TARP, Troubled Asset Relief Program, with $700 billion for bailing out banks. October 6th to 10, U.S. stocks suffer their largest weekly loss ever, by 200 points. Globally, markets crash. November-December, bailouts extend to Citigroup, Bank of America. Automakers GM and Chrysler also receive billions. These events triggered panicked reactions. Credit markets froze, banks refused to lend, trust evaporated. A full run on the shadow banking system and non-bank financial institutions spread globally. The feedback loop, credit crunch, economic contraction, more losses once credit froze. Businesses couldn't finance operations, consumers couldn't borrow or spend. The real economy faltered. Recessions deepened, asset values fell further. Losses mounted in banks, hedge funds, insurers. That triggered more credit tightening. We entered a vicious cycle. Leverage plus liquidity crisis plus contagion. Regulators hoped that stabilization and bailouts would halt the slide, but the scale was too large, and the trust had already cracked. The severity of the recession by mid-2009, the United States was in a deep recession. Unemployment surged above 10%. Millions of home foreclosures, consumer spending collapsed. Across the world, the contagion spread. Europe's banking systems, heavily exposed to U.S. securitized assets, reeled under the losses. Countries like Iceland effectively went bankrupt as their banks had over-leveraged on foreign debt. Eurozone sovereign debt crises emerged, amplifying the strain in economies like Greece, Ireland, and Spain. Governments pursued stimulus, bailouts, austerity, and many emerged with heavier debt burdens and fractured political legitimacy. The Great Recession lasted, in effect, from late 2007 until mid-2009, making it the deepest downturn since the Great Depression. King Center on Global Development, Human Toll and Structural Scarring. The crisis cost trillions of dollars in GDP, pushed inequality further, and created long-term scars. Many unemployed never fully recovered their pre-crisis incomes. Generational wealth, especially in housing and retirement, was decimated for millions. Investor losses and business failures wiped out capital and confidence across communities. Trust in financial institutions, governments, economists all collapsed. In policy circles, debates raged over whether more aggressive fiscal stimulus, regulatory reform, or debt forgiveness should have been implemented, and whether the response was too little or too late. The bailout strategy governments and central banks launched the biggest intervention in modern financial history. TARP. U.S. Treasury purchased troubled assets and injected capital into banks. Federal Reserve. The Federal Reserve created massive liquidity programs, lending facilities, swap lines, and purchased distressed securities. By March 2009, the Fed had committed $7.77 trillion to rescue the system, more than half of U.S. GDP. Globally, central banks coordinated rate cuts, injected liquidity, and governments raised bank guarantees. Many failed institutions were nationalized or restructured temporarily, e.g., AIG, RBS in the UK. These actions likely prevented a total financial collapse, but they came with trade-offs: moral hazard, ballooning public debt, and political backlash. Regulatory reforms and their limits in the wake of the crisis, and a wave of regulation followed. Dodd-Frank Act, 2010 in the U.S., tougher capital requirements, stress tests, Volcker Rule, restricting proprietary trading, oversight of derivatives, Systemic Risk Board, Basel III, global banking standards requiring higher capital buffers, liquidity coverage, and leverage ratios, stronger oversight of credit rating agencies, new macroprudential tools, countercyclical capital buffers, stress testing, resolution regimes for failing banks. However, many of these reforms were watered down over time. Firms adapted, loopholes emerged, and political pressures mounted to loosen restrictions. Crucially, the reforms focused heavily on traditional banks, but the shadow banking system, hedge funds, money market funds, repo markets, remained partially outside the strictest regulations. Thus, while the system was strengthened relative to 2007, its most vulnerable parts, complex derivatives, interbank funding, and opaque leverage, were not wholly reined in, disturbing data and parallels. Massive leverage still persists. Despite reforms, leveraged bets and derivatives, ETFs, prime brokerage, and repo markets have returned. The global financial system is still structurally tethered to short-duration funding. Asset bubbles abound in equities, real estate, especially in certain cities globally, crypto assets, and private markets. Valuations appear detached from fundamentals. Debt-fueled speculation remains. Central banks are trapped. Today, interest rates are near zero or negative in many regions. Quantitative easing, QE, is normalized. The next downturn may leave them with fewer tools to respond. Regulatory rollback risks. Since the 2020s, several jurisdictions have softened or rolled back portions of Dodd-Frank or Basel standards under political pressure, fragile liquidity plumbing. Money market funds, repo markets, and other short-term funding systems are still prone to runs or flight in stress periods, wild markets during shocks. In March 2020, during the COVID shock, money markets froze. The Fed had to recreate rescue facilities nearly identical to 2008-era ones. Only months earlier, in 2019, the repo market experienced a crisis zone, and the Fed had to inject billions in emergency liquidity. Concentration and too big to fail remain. The largest banks and financial institutions are larger today. Greater systemic risk if one fails. These are not coincidence. They are patterns. Easy credit, financial innovation, leverage, fragility, panic, bailout, partial reform, repeat. The cautionary patterns. The appetite for yield breeds excess risk. Complex financial engineering masks fragility, not eliminates it. Regulatory firewalls are always one political shift away from dismantling. Crisis response relies on trust. When that's gone, the system is brittle. One striking statistic: the Fed's balance sheet, which ballooned during the crisis, has again swelled in the tens of trillions in assets backed by governments, mortgage securities, and more. The cycle of stabilization is repeating. If history teaches one thing, it's that financial systems forget their near-death experiences too quickly. Takeaway 1. Crises are rarely about a single cause. They're about cumulative systemic fragility. The 2008 meltdown wasn't just subprime mortgages defaulting, it was loose monetary policy, global imbalances, regulatory gaps, shadow banking, over-leverage, misaligned incentives, and financial engineering all colliding together. Takeaway. 2. Innovation plus opacity to lurker danger, complex financial products, CDOs, CDS, synthetic derivatives, hid risk from investors, regulators, and even the institutions themselves. When they unravel, the fallout is unpredictable and brutal. Takeaway 3. Rescue today's seeds, risk tomorrow, bailout soon. Prevented collapse in 2008, but they also reinforced too big to fail. When institutions expect government rescues, they have incentive to take ever greater risks. Without structures to contain moral hazard, the next crisis may be worse. We are already in a world of compressed downside, low yields, high valuations, thin buffers. The next shock, whether geopolitical, climate, pandemic, or technological, could be the spark that unleashes a crisis far faster, deeper, and less manageable than 2008. We may wake up one day to a sudden freeze in short-term funding markets, cascading margin calls, and global capital flight. The system is more complex, tighter, and more interconnected than ever. If we don't respect the lessons of 2008, we may discover them all over again. If you found this deep dive illuminating, hit like and subscribe to this channel. Leave a comment with your thoughts. Do you believe another financial meltdown is imminent? And share this video because, yes, the next crisis might not wait for permission. Stay curious, stay vigilant, and until next time, look behind the numbers